following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Welcome back to NinjaTrader Live. This is the segment of the show we call Traders Workshop. I'll be your host, Tom Schneider, CMT with NinjaTrader. And as is the case with Traders Workshop, we like to bring in our ecosystem partners. And we have one of the first guests from Traders Workshop a long time ago, 2 years ago almost, co-founder of Spot Gamma, options expert extraordinaire, Brent Kochuba. How you doing, Brent?
I'm doing great. Thanks very much for having me on.
Oh, yeah. My pleasure. Always great to have you on. And it seems like every time we speak, you have a little bit of a different setup. And you have a great reason. You're traveling this week, right?
I am, yeah. So you commented that it looks like I'm in prison. I'm not in prison, but I did have to find a quiet place, which I have some little kids, and that could be tricky. So here I am. Like I was saying before, OpEx week happens the same week, and you can't stop it. So you got to produce the content when you can.
Well, we appreciate that you're joining us here. I know, it might be a little difficult, like you said, with the kids, but you're doing it, so we appreciate it. And travel with kids, not always easy, not always the easiest thing, but once you get to your destination, a little bit of relief sets in, right?
Yeah, that sounds like a trader axiom there.
There you go. So let's get into it. We have you on an options expiration week for a reason, because this is your business. This is what you know. And it seems like every options expiration week has a little bit of a different spin or a little bit of a different flavor to it. We talked last month about March being very important, right? It's triple witching. It's the quarters every 3 months. There's a big, possible hedging issue going on. But what's the key takeaways for April this week? Of course, Friday being options expiration.
Yeah, there's a couple interesting factors. So in March, what we were seeing was evidence that big call bid that was present in markets. If you think about how rapidly the chip sector was going up and kind of a stock up, vol up regime, a lot of call activity. March, by and large, is marking kind of a breaking apart of a lot of those flows. And in particular, if you remember, we were flagging the NVIDIA event, which was their GTC conference. Volatility in that space was very, very elevated, and NVIDIA is really the poster child for the market rally that had happened this year. And the thing that was on the radar was, look, the volatility, implied volatility, is very high for this sector because people were buying so many calls and had such bullish expectations. And when that event happened, that volatility in that sector, implied volatility, came down, and those stocks have really, they topped out into that right after that time frame, right? And they really trended sideways up until even about a week ago, right? We seemed to have lost a lot of the energy that was behind the market lift. And now what's happened in just the last week is obviously there's the geopolitical situation. Everyone's well aware of that and the risks associated with that. But there's also a bunch of interest rate changes that has created cross asset volatility, really. So if you look at volatility in gold and oil volatility has been picking up quite a bit, FX volatility, and then obviously the rate volatility is the other big one with that hot CPI last week. And so, what has really happened is the leading sectors of the equity space lost their momentum after incredible rally and performance, and that led to equity pause. And now what's happening is a lot of the reflexive flows that built up around, pushing the market higher, those stalled out, and now we're getting what I think is just a broad correction at the moment in a lot of these flows that have kind of bed feedback loops. And what's interesting about that, now obviously we had VIX hit 19, which is a 6-month high. And equities are down, S&P's down, 3-4% over the last 5 days. It's still up 6% year to date. and we're approaching the 5,000 level. 5,000 is a massive support level for the S&P 500. I don't think we're going to break that this week unless the Iranian, Israel Middle East conflict really steps up another ante. And that is because we have OPEX this week. We have VIX expiration tomorrow morning, and then we have equity options expiration on Friday. And those are now very put heavy. There's a lot of very high implied vol. A lot of VIX calls are going to get cleared out now tomorrow morning with VIX expiration. Other put positions in equities broadly, I think, are going to get cleared out. And so barring a major sort of step up, which I think people are anticipating a step up, so it's a major asterisk here. But barring that, I do think we could get a little bit of a relief rally now into this OPEX window. And I don't know that people should misconstrue that as a larger rally is going to occur off this bottom, but there are some flows in here that I think could put a little bit of a bid in markets for the next couple of days.
So a lot to unpack there.
That was a lot.
It was a lot. But, kind of this overall idea of the leaders having been the chip sector maybe, or the magnificent seven. And I think even back then, a month ago, we were talking about maybe no longer it's 7 stocks, maybe it's 4 or 3 or whatever it is.
Yeah.
We're starting to see that pause. You had that NVIDIA, Apple like conference.
It was Steve Jobs like it was invoking that kind of interest, right?
Right. And it kind of, from what I remember reading about it at the time, it was kind of a dud, right? It didn't really announce a lot of interesting movers.
Yeah.
NVIDIA.
And
go ahead.
And on this chart here is what we call term structure for NVIDIA. And so you can see how elevated this green line is. This is NVIDIA term structure into that 318 event that you just mentioned. And the shaded cone, this is from our volatility dashboard on spotgamma.com. But you look at it, you can see how elevated that term structure is. That's telling you that implied volatility, or people's view of how high volatility is going to be into that event, was extreme. And so to your point before about it being a dud, a lot of times that's about expectations, right?
Right.
NVIDIA had blown out earnings and chips, and it's the God stock, right? And how do you improve on that? If people think you're God, what other level is there, right? There's no other level up from that. And so they would have had to produce, I couldn't even tell you what they could have produced to say, hey, you're earning the pricing that people are putting in this event. So the event comes out, the shaded cone is the zone of where implied volatility has been over the last 90 days. And now what happens is you see, this is the current level of implied vol term structure, this lower box. This is from yesterday morning. This spike you see in term structures around their earnings. So one of the things that we're flagging here is that, hey, look, if the geopolitical situation cools off a little bit, and then we get NVIDIA coming back with like, hey, everybody, don't forget this story of the massive amounts of revenue that we're driving from, chip sector, AI, whatever. And you had the election. So, there are reasons that you could get bullish a little bit out in time here if that earnings story picks back up. But just back to your original point, the expectations were so high they couldn't ever have been fulfilled, right? And
Right.
Now we have much more modest expectations. And what I think you broadly have to just consider consolidation in the market, a correction, not really a sell-off.
Right. We're still in a bull market, right? It's a pullback. How far we pull back is, remains to be seen. It just seems like we've been getting accustomed to a bull market for, beginning of last year, almost, maybe even before that, maybe October of 2022, that any kind of pause that doesn't fit the pattern that's been going on since, a year and a half ago or whatever it is, seems to be, is it time yet? Is this run over? And I think that's natural. It's natural to question it. But, curious to know, like you mentioned, was it 5,000 was amassing of calls at 5,000?
There are big positions, calls and puts at that 5,000 level. And you can see that on our chart here. This is call gamma in orange and put gamma in blue. And so we're in between this 5,000, 5,100 space. And so I think that if we get back over 5,100, that's a signal that 5,200 comes into place pretty quickly. And then that's what our neutral zone is in terms of what we call risk on, risk off. And if we get back over and we move into much more of a call heavy regime, and then that's kind of like business as usual. It was just a correction and we continue this path higher. And so what's interesting in this space here is that 5,000, it's a psychological level because it's a big round number, but there's huge positions at that level. And what I've made the case for, particularly on our subscriber note this morning, we really, I parsed through this, is that even though the VIX is at 16, or excuse me, at 19-ish, we've not seen volatility yet. Like, this has just been like a little taste. The big volatility has not really shown up yet. And below 5,000 is this level where I think we finally get to one of these vol events where we go, hey, you remember, the last one we had was March of 2023 with the bank crisis, right? Where like, oh, this is getting a little gnarly here. And there's people holding Twitter spaces or whatever on the weekend. And, everyone's like freaking out. And that is the kind of event I think that would start to come back into favor if we break 5,000, because I had mentioned a lot of these reflexive flows. We put a video out on YouTube. You can find it. It's called Volatility Suppression. And it highlighted how bizarre this current volatility environment is. And to give a sense of that, I wanted to show this chart here. This is the number of days, and this is from our presentation. It's a couple of days old. This is the number of days that we've not had a 2% drawdown. Now, we're still in, despite the weakness, we still have not had a 2% one-day drawdown in the S&P 500. So we're in the third largest period ever. We remain in that period. And simultaneously, we didn't experience it was really only one day in the last 412 days plus where we had a 2% up move in the S&P 500. And so what's so funny about that is, and this was NVIDIA earnings. So we have that one day and we haven't had a 2% rally close to close since. So we have a period of index S&P volatility is nothing at all. We've just been like in a straitjacket grinding up and up and up and up.
Right.
Now, so we're now still in this period without a 2% drawdown. And there's war, there's interest rate volatility, there's all these other reasons for the market to kind of have a little bit of a spasm, I would say, and we're not getting it, right? What's interesting about this is that there's a lot of talk about zero DTE flows and the impact of the systematic call overriding and things like that. And I think a lot of these flows are, let's just call them technically driven or positionally driven. We like to look at the market as this positional analysis. And I think that even though things have been grinding down so far, we're down again 4% last week, which is real, but it's been controlled, I would say. And it's because I think of these reflexive flows, right? Dealers have a little bit of a long gamma position. I think dealers have a long vega position, meaning that they can supply liquidity to the market when the market's coming down, and that prevents a massive drop. And I think if we break 5,000 in the S&P, that's where that dealer flow stops supporting the market and maybe turns against the market, and then you start to get a bigger series of drawdowns. And like I said, my subscriber note this morning is like, this isn't like end of day scenario. It's just like, hey, we're actually getting volatility, because still a 2% drawdown, it's high, but that's not this kind of thing that's like, hey, we should go 2+ years without a 2% drawdown, right? It's just that's not normal in what I would say. The other thing I want to highlight about this is that if you look at these periods of how they ended, right, these streaks of where we haven't seen sell-offs, it's pretty ugly. This one here, number 2, is Volmageddon. So February 2nd, 2018 is when Volmageddon hit. That led to a 10% drawdown in the S&P 500. Number 1 is interesting because it was 3 or 4 months before the great financial crisis kicked off, which was really kind of June of 2007. So the market in this case had a 4% drawdown, then recovered to a high in June. Great financial crisis kicks off, and down we go. The other interesting ones on here, 10/10 of 2018, market had a brutal fourth quarter in 2018 that led to the stock market low happening the day after December options expiration. That's a famous, Mnuchin famously called the banks and was like, hey, you guys have support from us. And then the market eventually rallied. I think that was the Powell pivot too, I forget. And then the last one I just want to highlight on this list, which I thought was fascinating, is number 8 is the COVID crash. So we hit February OPEX of 2022. And then all of a sudden after that, if you remember, everyone's like all these people in China are dropping dead on the streets. Like, COVID is real. Like, why is the market still going up? And then all of a sudden it was like one day we just realized it all. In the course of like 2 weeks, the market just crashed into March. So I don't want to sit here and fearmonger and say, hey, look, we're going to approach this vol event that we talked about for the next 10 years. I'm just simply trying to say that, like, look, and there was an article in the Wall Street Journal this morning that said that this is not a stock market bubble because, like, they alluded that maybe the selling is done and we haven't had a lot of volatility, right? And so it's not a bubble to the upside. Well, the other side of that equation is, I think if we break 5,000, then suddenly you start to see 2% drawdowns, right, or a string of them at least, and we start to pick up the pace to the downside quite a bit more. So
Well,
from that
and Brent,
perspective, yeah.
to your
Thank you
point
for cutting me
about,
off, by the way. I
sorry,
can't blabber on.
no,
No, no,
I,
no.
I want
I
to
keep
grab these
going, man. That's
ideas
my
as they
problem.
come. So, to your point, you picked out like 4 or 5 dates that preceded a major event, but there are still 5 dates that really don't strike me as major events. And, I remember February 2007, that was
Mhm,
a big deal. And that was before the real big deal, right?
mhm.
I remember because I had just started a new job and that was, kind of, uh-oh, what have I got myself into? But, um, when you do have a momentous event, sometimes it just, like you said, doesn't happen in one day or whatever. There is some lead up to it, so it's not surprising that a 2% drawdown precedes an even greater drawdown, continuation. And
Yeah,
but you have 5 dates here or 6 dates here that didn't have that follow through. So I agree. You know, i- it's kind of like, okay, well, it's one of those stats where like, a horrible stat, but like getting pulled over by the police happens, a large percentage of time near your house. It's like, well, you're always going back to
you're
your
always
house.
back.
Of course it happens, right? So, it's kind of like whenever we have a big
Yeah,
drawdown, it just doesn't always happen on one day. It can start with a 2% move, but that's really fascinating. And
yeah.
Mike Burke has been pointing out the VIX on our midday wrap up and sometimes on the bar's closing show, and he has pointed out, yeah, we're finally seeing at least a spark of increased volatility, where it popped above 16 and then 17 and then hit 19. Like, it's kind of you know, pay attention, right? It's still at the low end though, which is interesting.
Yeah, and this chart to exactly your point. And look, 2% is a bit arbitrary, right, in terms of picking a number at random, but
Sure.
I just want to say that there are these times where in the markets where you just feel to yourself, you're like, I don't quite understand what's going on here. It just feels weird, and it takes longer to have that rectified. And I think that was the great financial crisis where everyone knew it's like, hey, you know these people, like the Big Short movie, right? Like these people in Florida, like where are they getting money for these houses, right? This can't keep
Right.
going. And involve them again too. It's like how is this stuff happening? Like I could just keep selling, short the VIX and here we go. But anyways, so we just came off of the lows of volatility since the COVID crash, as you can see with the VIX chart here. We really been in a VIX 20-ish environment for the last 5 years. To your point that you just made, that your colleague was marking. This is what we call 2-month skew for the S&P 500. So this looks at the skew of options 2 months out in time. And just 2 weeks ago on April 1st, again, this is from our spot gamma dashboard, you can see this yellow line shows us that on a 2-month basis, which people, if they're concerned about upcoming events, I call it the unknown known. So it's like, I know there's a war or the possibility of wider conflict in Iran, Iraq, in the Middle East, excuse me. And so you have this situation where vol could pop, just like in the March crisis last year, the bank crisis. I know banks are going belly up right now. I just don't know which ones, and I don't know when. So I need
Right.
to buy longer dated options to hedge myself. I can't use zero DTE. So 2 weeks ago, there's no concern, right? Because this yellow line is at the bottom of the shaded cone, which was the 90-day range. Now, that 90 days was a very calm period of volatility, right? Very, very historically calm. So now this green line, you can see that we've elevated. This is the implied volatility for options that expire in 2 months. That is now elevated, right? It's perked up to, again, to your colleague's point and to the point of the 19 VIX. So it's like, oh, okay, we're normalizing a little bit, as opposed to saying like there's absolutely no risk that we have at all, which is kind of what that yellow line is stating. And to this point, also, we had record VIX options volume writ large on Friday. I don't know if we broke that yesterday. I didn't check. I need to do that. But we had record VIX options volume. Now, this is options volume, not necessarily call volume. What's interesting about this is that the change in VIX call open interest was very, very small. So
Mhm.
what is happening here is there's a lot of rolling because we have VIX expiration tomorrow. So people are taking advantage of this high VIX and rolling positions out in time, which I think does two things. One, it helps to keep volatility a little bit suppressed now, but it also puts all these larger positions on out in May or June. So there's still this upside convexity that could exist that the VIX starts to lift. There's still these big positions that could help the VIX kind of accelerate higher, I think. So it's a short-term dampener, I would say.
So real quick,
and then
Brent,
the last, oh, I'm sorry, go ahead,
can I
please.
just say about that
Please.
point? It's earnings season just began. We've got financials coming in. You mentioned the bank crisis last year, increased a little, introduced a little volatility. VIX spiked up and then went back down. I'm concerned about commercial real estate affecting the balance sheets of these banks, and they're starting to, Powell, or was it John Williams mentioned it last week? Powell might talk about it today. I'm not going to say he is, but the banks are starting to mention it. And is this something where it could be the next thing? We kind of thought 2007, beginning of 2007, we had a little bit of a correction, and then market spiked up before the Great Recession. Could SVB last year kind of be a prelude to what the banks are doing this year, and just a little bit of a longer time between those prices? I'm not saying I want to be the I don't know spoiler, but it seems like we might be hearing about commercial real estate affecting banks a little more than usual.
Yeah, you bring up some great points, and I want to talk about two quick things of that. CPI last week sort of evaporated people's perceptions that there would be rate cuts this year. Maybe we'll get one before the election. I'm in the camp that the establishment is kind of going to do what it can do to support markets and keep calm into the election. I don't think you can kind of pace that over. At any rate, this chart on the left here is the U.S. Treasury 5-year single-day change. We had the largest change last week, one-day change in 5-year rates that we've seen since March of 2020. That is rate volatility. And if you look at this chart, it came out yesterday from the SIBO. This is volatility across assets. And what you can see into March, and I'm not saying that March options expiration caused cross-asset volatility. It just so happens that kind of at the end of March, we see gold volatility spike. We see equity volatility start to spike. We see oil volatility spiking. We see FX volatility spiking. We see credit volatility starting to move up, right? So all of these things are lifting. All of these are related to rates, right? The one thing, and I'm not, the Mr. Macro here, but I would say that the one thing that the credit markets and commercial real estate don't want to see is higher rates right now, right? Because that makes their financing more difficult, et cetera, et cetera. And so all that volatility is starting to increase. That matters to me in the equity space is because that volatility will cross-contaminate, obviously, into the equity space. Mm-hmm. Equities and bonds, right, have moved to a positive correlation since interest rates started going up in 2022, meaning historically we all use the 60-40 portfolio. I have bonds that hedge my equity position, right?
Right.
When we started to raise rates, it's 2022 showed that hedge didn't really work anymore, right? Bonds lost money when equities lost money, and it was a painful experience for everybody. Now that you have rates back at 5%, the worry is that inflation isn't going down. So do you really want to rely on bonds as your hedge if you think interest rates and inflation are going to go up? I would say that it may not be an effective hedge. Maybe it is. I just think it wouldn't be that effective, which means that the only place, if you really want to hedge your portfolio, your equity portfolio, it leaves you with two options if you're concerned about downside. One, you can sell your stock. Two, you can buy puts or VIX, long volatility positions to hedge your portfolio. And if that happens, then that demand really starts to lift up equity vol. And I think that is the thing that we need to think about because equities are back to all-time highs. And if you start to have credit events in the market, one of the prime ways that you'll hedge credit event is you'll buy put options. So if you own some mid-cap bank and you think it's going to go belly up and you have a bunch of bonds, you probably don't want to sell those bonds. You can't get liquidity. So you go out and you start to buy puts on that entity because the equity is going to lose value first anyway. So that's where a lot of major demand can come for downside volatility hedges. And so, that's how I see the lay of the land and kind of the chain of events from this cross-asset vol into equity vol.
Wow. Okay. We've got a couple minutes left. I interrupted you, so maybe we can go to that point you were about to make. Fascinating.
Yeah. So I don't, and I want to sit here and paint this incredibly dire picture of things going forward. I mean, I'm not a macro analyst, and so I don't want to state that, but I do think that this evidence of the lower volatility regime ending, which we've been in for the last 6, 7, 8, 9, maybe even a year, 9 months / a year. One of the side effects of the lower volatility regime we've been seeing in the zero DTE flows, call overriding flows, was a decrease in correlation. Correlation tells us how much individual components of the S&P 500 are moving relative to each other. So what does that mean? Well, when the chip sector is the main sector going up and all other stocks in the S&P are kind of just lagging behind, that means correlation declines. Correlation spikes when all stocks drop. So March of 2020 is this huge spike in correlation because every single stock went down, right? All of them. And so what we're seeing here is we had record low correlation. This is the SIBO measure, 3-month, and you can see that's starting to lift. It's weird that it's lifting into earnings season because oftentimes people start to hedge earnings and that breaks the correlation up a little bit. But what you're seeing here is the effect of people arguably starting to say, hey, I need to reduce or adjust my equity allocation writ large. And so what happens then is all stocks go down because now we're going to shuffle out of equities and into something else, based on, reallocation essentially. And we're also seeing that, again, kind of like that VIX chart, this is what we call the vol. You can look it up, VOLI. It's 1 month spider implied vol. That's starting to lift. So that's people starting to price in more movement going forward. And what I think is this is signs of the regime that we've had ending, right? These very calm days ending, or very calm period without 2% moves, VIX very low, et cetera, et cetera. I think that period is starting to come to an end. And when you start to look at the Middle East conflict, I don't know that resolves anytime soon. Again, I'm not a geopolitical analyst. I don't know. I don't think it resolves tomorrow. Then we have the FOMC, which could be an interesting one based on people's understanding of rate hikes and what's happening, what's not. That is on May 1st. So there's no real reason for volatility to calm down a lot before then. And then at that point, we also start to get into this election season, which always demands a lot of high implied volatility, right? People are always hedging out whatever they may be hedging into the November election. So, there's a lot of reasons to think that things are going to keep moving a lot over the coming months. And that kind of real calm that we've had the last, call it 6 to 8 months, that regime may be ending.
Wow. Okay. So Brent, great information. We've run up against time. Where can people find you? Because I think it's fascinating and people want to learn more about it because this is just the tip of the iceberg, I'm sure.
Yeah, thanks so much, Tom. Thanks for listening to me just kind of ramble on their segments. You can find me at spotgamma.com. You can find us at spotgamma on Twitter as well. And on YouTube is where you can find the video on volatility suppression. So please check that out.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.